With tax season upon us, what better time to talk about taxes than now? I promise this is not clickbait, and I will show you in a moment how I ended up getting such generous tax refunds over the last 20 years. But first, did you know that in the US, the average single worker paid 30% in taxes last year? And in Canada, for the top bracket, which applies to amounts over $246,752, income was taxed at 53.3%. In essence, you ended up giving more of your money that you made to the government than you kept yourself. With such numbers, I make it my business to legally leave no money on the table. But first, please note, this is not tax advice. This video is meant for entertainment purposes only. I'm only sharing my story. If you need any advice or guidance regarding your taxes or finances, consult a tax professional or a financial advisor. And for completeness, full disclosure, I have a background in accounting and finance. In fact, I have worked for a tax firm and I have volunteered for the Canada Revenue Authority for years. Over 10 years, I've volunteered. Not recently, not the last few years, but in the past, I've volunteered for more than 10 years. So now that that's behind us, let's get on with it. There really is no secret to getting a big tax refund, but first I can already hear them say, you really don't want a big tax refund, because what a big tax refund means is that you're loaning the government interest-free money for a year. But that's not totally true. Even then, would you prefer to owe the government, or would you rather the government owed you? I know where I stand. How about you? Just to be clear, anybody can request to have tax deduction at source reduced. You simply have to fill out a form that you can get on the website for the CRA. I believe it's called a T1213. Then, if approved, you'll get a letter of authority. I think that's what it's called. And then give it to your employer, and the tax deductions of your paycheck will be reduced. Otherwise, the only options you have are what I'm about to share and the way I get tax refunds. Here we go. First, before we proceed, here is a summary of my tax refunds over the last 12 years, from 2011 to 2022, the last year when I filed taxes. I obviously haven't filed taxes for this year. And you can see that the average annual refund I get is over $5,000. Now, for the sake of explanation, I'll divide this video into 3 parts. First, let's talk about the technical ways to minimize your taxes, which really just boils down to one thing. The 2 main ways of reducing your taxes payable are deductions and credits. And while they both work to minimize how much taxes you pay, they're very different. Deductions reduce your taxable income so that the base on which the government applies a tax rate is lower. Credits, on the other side, reduce the tax amount that you would have been billed on taxable income. Once the taxable rate is applied to your taxable income, you have a tax amount that you owe, right? Credits reduce that amount when you apply credits to the taxes that are supposed to be paid. Here are some examples of tax deductions: contribution to your RRSP, contribution to Fast Home Buyer Savings Account, FHSA, union dues, childcare expenses. They are endless. For self-employed individuals, their expenses for your work, moving expenses if you're moving more than 40 kilometers to start a new job. In total, there are more than 400 deductions and credits available to Canadians. Here is an illustration of how deductions work. Let's assume a tax filer named Mary is trying to file her taxes for 2029, and she has 3 different sources of income. Job 1 is a part-time job, and she brings $40,000 from that. Job 2 is a full-time job, and it's a unionized position, and she earns $50,000 there. And her 3rd source of income is rental income. She rents a room in her house for $1,000 a month, so a total income of $12,000. In total, Mary's income is $102,000. Then, also in 2029, she contributed $12,000 to RRSP, paid union dues worth $900, and spent $3,100 to buy a new cooling system for her rental unit. Based on these numbers, her total deduction would be $16,000. When she applies this to her total income of $102,000, her taxable income is now $86,000. Now, let's further assume that her tax rate is 22%. If you apply the 22 to the 86,000, then her taxes due would be $18,920. Now, let's look at credits. Then we'll get back to this. Credits help reduce the amount of taxes you pay. So in Mary's case, credits would reduce this $18,920 once applied. And credits include things such as your eligible dependent. home office expenses, tuition tax credit, tuition loan interest. And I remember there used to be credits that I used in the past, including public transit pass credit. There was a credit like that. And there was a child fitness amount credit. So there, like I said earlier, there are over 400 credits and deductions available that you could employ. Now, let's assume that Mary contributed $900, say, to charity during the year. In that case, this would be applied to her tax of $18,920, reducing it a little further. Now, remember, this illustration is very simplistic. You do not apply a dollar for a dollar. So her contribution of $900 to charity would not apply a dollar to a dollar. So it would not reduce her taxes by $900. There's some other calculations behind it. So in principle, that's the technical way, using deductions and credits to reduce your taxes. Now, let's look at my journey and my story, because predominantly it's just the way I used deductions and credits and carried forward and applied them to my income. That's how I ended up getting all these huge tax refunds over the years. In 2001, I was an international student paying very large tuition. I spent, I think, $40,000, $50,000 in tuition amount, and I did not have an income, so I could not use the tuition tax credits. So I carried this forward. I believe you can carry forward tuition tax credits for, I think, indefinitely, or maybe 7 years. Don't quote me. I think it's indefinite, or into the future until you use them, or you can transfer them to other family members. So I had tuition tax credits. Then when I graduated, I got a job. It was an entry-level position. So I could not use all my tuition tax credit. Within a year of starting to work, in 2005, I decided to go back to pursue a graduate degree, and I decided to bankroll it with my job. So I worked full-time and pursued my graduate studies through night school. And because I was bankrolling my studies, I did not contribute to my RRSP. So I grew that room as well. But I did take advantage of my employer's contribution, which was really minimal. I think it was about 3%, but otherwise my RRSP room just grew. So remember, I had this huge tuition tax credit and I went to pursue graduate studies. And in that process, I accumulated more tuition tax credit. Then around 2008, I got a better paying job in downtown Toronto. So at that time, I could then quickly use up most of my tuition tax credits. But I also got a job that was in a unionized position, and my employer offered a really good pension plan. Now I was contributing to a pension plan. I could claim pension adjustments. I could claim union dues, but I still had RRSP room that I could contribute to. And I still had tuition tax credit, to be honest, when I started my newer job in 2008. And so I also worked downtown Toronto and lived out of Toronto. I lived about an hour out of Toronto, and I was taking public transit. And like I mentioned earlier, there was a public transit pass credit. So I bought weekly passes or monthly passes and accumulated further credits that I could use. Then in 2010, I had my child, and while the relationship did not work out, I became a single mother, and now I could claim my child as an eligible dependent. And because I was working full-time, I had huge childcare bills. So you can see how progressively, as I lived my life, I kept on identifying all these credits and deductions that I could apply. And earlier in the life of my child, there was another tax credit known as the child fitness amount. And so my son went to summer camp, went for different activities, played basketball, played karate, went swimming, and I paid for all these out of pocket, but I could claim them. So in principle, it's just the way you apply the credits and deductions and that you're mindful of them that you end up reducing your taxes. So that in essence is how I ended up getting these big tax refunds. Ultimately, I ended up exhausting my RRSP contribution room only in 2023, so last year. Even when I file my taxes for this year, I am sure to get a good refund. Now, to the third part of the video, which talks about steps you can take to minimize your taxes. First, educate yourself. Learn about credits and deductions that you could take advantage of so that you can help minimize your taxes, especially if you do your taxes by yourself or if you're self-employed. So then that way, if you're self-employed, when you approach a tax professional, when you're knowledgeable, you ask the right questions, which also forces them to think of credits and deductions that they can help you with. Tip number 2, work with a knowledgeable tax professional. Just because your uncle's sister-in-law has a software that can help you prepare your taxes for free is not the most optimal tax strategy. The best tax strategy is to work with a knowledgeable tax accountant to help you identify credits and deductions that you may be missing. Third tip is when you go for your tax appointment, take all documents that you think might be relevant. When in doubt, take it. Especially for the self-employed, take all receipts and credit card bills and invoices, because if you can prove it to the tax accountant, they may not want to enter it in the system. Another document that people tend to forget to take to tax appointments is the NOA for last year, the notice of assessment for your last tax season. That document usually carries some valuable information. For instance, your accumulated RRSP contribution room. So plan to take that with you to tax appointments, especially if you're moving to a new tax professional to do your taxes. If you're not working with one tax accountant year after year, take the NOA with you when you go to a new tax accountant. So these are some of my tips. And on top of that, even without a tax consultant or without a tax advisor or a tax accountant, if you have a large RRSP room, you're not doing yourself any favors. By starting to contribute to it, you're both building a retirement fund and helping minimize your tax bill. I hope you found this video helpful. If you did, please consider liking and subscribing. It helps the channel grow. Thanks for watching.